So now let me hand over the microphone to him. Mr. Lee?
Thank you. It's my great honor to be a moderator in this with a panel with the distinguished colleagues here. First, I think we have to really finish this panel, unfortunately, by 3 o'clock. I heard from the Bank of Korea that this room will be used for other events immediately after our session. If we cannot vacate this room by 3 o'clock, I have to pay more extra money. So I have a full incentive to finish it by 3 o'clock. Okay? So that, you know that all these distinguished panelists, so I wouldn't repeat the introduction again, but I will just focus on our 2 colleagues who hasn't been in our previous panel. So let me just introduce Dr. Subir Gokarn on my left side. He's the executive director in IMF board, representing India and a number of South Asian countries. Before, he served as a deputy governor of the Reserve Bank of India. He also was the chief economist of Standard & Poor's for Asia and the Pacific, and the senior fellow and director of research at the Brookings Institution India Center. And on my right, Mr. Hiroshi Nakaso is a deputy governor of the Bank of Japan. He has served in various positions at the Bank of Japan before. Previously, he worked at the Bank for International Settlement and served as chairman of the BIS Working Group on Policy Challenges and Open Issues in Liquidity Assistance. And other panelists are already introduced, so I will skip it. So why don't I have a first round of questions with the panelists? And then I heard, since we didn't have enough interaction with the audience, I will open the floor and then receive some questions. And after that, if I necessary, I may go over the second set of questions. So let me start with Adam. Adam, yesterday I was intrigued by your remark that you don't believe the inflation targeting is very effective. And then we have today a good presentation by my colleague, Douglas Exton, and your colleagues, Joseph Gagnon, seems to suggest that inflation targeting seems to be a good framework. So I was a little bit confused. So let me clarify some of your position. You say that inflation targeting has not been very effective in raising inflation after the global financial crisis. And you do not believe in inflation targeting. But at the same time, you seem to suggest that 2% inflation in Asia seems to be too low, so it's better to increase it. But I was a little bit confused. So if you want to increase the inflation from 2% to higher in Asia, okay, whatever the reason, and what kind of framework you are suggesting if you believe that inflation targeting is not a good frame to do? So I want to have a more clarification. Go ahead.
Thank you, Changyong. Thank you all for giving me this opportunity. I am very honored to be with so many distinguished officials, and I'm a bit chagrined to be taking up any of their time. But more than for the sake of argument, for the sake of forcing people to deal with some realities, let me try to answer Changyong's questions. What I've been trying to say is that inflation targeting is a good fair weather regime, but it is not a good foul weather regime. And having been not as influential perhaps as Doug Laxton, but having been there at the birth of a number of inflation targeting regimes, I say this having changed my mind and having, I believe, learned from the last decade or 2 decades. And the key things I would suggest that we've learned are, whether it's adaptive expectations or other factors, that the very forward-looking model of inflation targeting that was all about anchoring expectations and manipulating expectations through central bank communication has not done well. And much of the success ascribed to inflation targeting in the past seems to have been abetted by other factors that drove down inflation over the long term. And I actually don't think, I'm not going to speak for my colleagues, but I don't think this is that much in conflict with at least the way Joseph Gagnon discussed the Japanese and other experiences this morning. It's not that inflation targeting is bad. I believe it is better than a simple rule. It is better for almost every economy except very small open economies than a peg. I believe it is better to be transparent than not. I believe it is better to have a clear target for at least the area of policy that matters on inflation targeting. I think all that is positive. But what I think people are failing to reckon with including in the central banking community, is two facts. First, that the world really is more about you're either in a bad state of the world or a very low inflation state of the world, or you're in a relatively good, more highly variable, higher average inflation state of the world. Now, again, I heard Anna Cavallo today invoke what's been happening and what's happened in her past in Latin America. I've heard many people here who are from developing economies. Obviously, you do not win wonderful things by driving the inflation rate up to 25%. But the idea that the inflation rate is such a simple function of so-called central bank credibility and that it is subject to such spikes in the global situation we have been in now for more than 10 years, I think is mistaken. And so a lot of what you think about, and this again goes to some things that I think Doug and Joe said, but I'll take responsibility for, is that you are about trying to buy insurance against ending up in the bad outcome. And the second thing that goes with that is, as I tried to say yesterday, we saw in the Korean case, you can estimate a Phillips curve that has a pretty steady coefficient on it, or you saw in the scatter plots Joe presented that there are nonlinearities, which most of us assume that if you get out of the very low inflation trap, the Phillips curve starts to have some traction again. I have no problem with any of that. But you have to recognize just how far that is from where we were when we started inflation targeting, in which the assumption was that you had a very rapidly vertical Phillips curve, that Phillips curve moved about and jumped about quite a bit due to central bank commitments. I know this because I co-authored the chapter with Bernanke, Laubach, and Michigan, in which we said this up front, in which defining the target back and forth made a huge difference to the movements of this very vertical Phillips curve, and that's just not realistic. And so, I'm sorry to go on so long, let me just try to make it very practical. So the first thing is, if you are an emerging market or you're in an advanced economy that's fortunate enough not to have been dragged into the low inflation state, we all pay lip service to the idea of taking out insurance against the zero lower bound, but I would argue it is much more costly not to take out the insurance than I think people are acting. So we all say in the abstract this is important, but nobody is changing their inflation target. Nobody is taking the additional measures necessary to get us that distance. The second thing I would say, which goes to the tension that Changyong rightly points out in what I was saying, which is I want the inflation target to be higher, but I don't think declaring the target higher gets you up there. I think that is a reality. My colleagues from the Bank of Japan can speak to this very well. I believe, however, it is necessary, even if not sufficient, to say that we are going for an inflation target that is credibly further away from 0, 4, 5, 6%. And that you then have to coordinate more with many of the other policies, which is, of course, what has been discussed today. And that, in particular, I would say these issues of labor supply and wages and benefits, which came up in Kyoji Fukao and in Jonathan Wurzel's discussions of Japan, which are coming up again in the political discussion here in Korea of minimum wages. These kinds of income policy effects, I think, have to be taken seriously as part of getting you from the low inflation state to the medium inflation state. It may not be persuasive, but I hope that's at least clear.
Okay, I think I don't know whether I'm fully understand, but still, looks like the key message is that 2% is better in Asia, for as an insurance, inflation is better to be higher, and then monetary policy alone may not be able to achieve it. So you need some kind of help of other policies, more comprehensive policies.
Yes, that's correct. If you're already in the low inflation state.
Okay.
If you're not in already the low inflation state, then you want to validate staying above that state by raising the target. And if you're in that situation, the inflation targeting is more effective. I think you understand it better than you pretend.
Okay. Okay, thank you. So we may probably, the floor may have many other questions later, but I think it's the right time to move on to the experts. Nakaso-san. So you may actually chip in, what your opinion, what just Adam says, but I will get the question later. But first of all, for my own benefit, because I have to, work on the economic outlook too, I was really surprised to see the first half growth rate in Japan, 1.7%, which was much higher than we expected. but still inflation rate is very low. Does it mean that our concern on the new mediocre and secular stagnation in Japan and Asia is misfired? And what's the main reason for this high performance and the low performance in inflation in Japan? And also, if you allow me, I want to go back to the question that one of our colleagues from BIS actually asked, because we are worrying about the possibility of the new mediocre in Asia. So we want to prevent it, as Adam mentioned it. So then what should be the lesson that we can learn from Japan, good lesson, bad lesson, to prevent from fall into these bad situations? Please go ahead.
Thank you, Changyong. So I think there are basically two questions. Let me first begin with your question, why the economy is strong and inflation weak. Yes, the economy is strong. As a matter of fact, it's running well above the growth potential, which is estimated to be around between 0.5 and 1.0. In the meantime, the inflation rates are quite weak, despite the fact that output gap continues to improve and wages keep creeping up against the backdrop of acute labor shortage. With the unemployment rate as low as 2.8%, this is, by the way, full employment as we judge. I heard this morning from Mr. Gagnon that the labor market may be not tight enough, but I disagree. Our labor market is very tight, extremely tight. So the question is why the prices are so weak when, as I said, macroeconomic fundamentals are so favorable. I think weak prices may be attributable to some one-off factors, such as reduction in sales prices and charges for these smartphones. These are one-off. But more fundamentally, I think it seems to me that corporate firms in Japan are trying to absorb the wage cost pressures without passing them on to the sales prices for now, by mainly the following three means. First, they are streamlining their business processes by doing away with excessive or unnecessary services for which the labor costs are too high in light of profitability. For example, some retailers and delivery service providers are reducing business hours by discontinuing business late at night or early in the morning. Now, these streamlining notwithstanding, we hear that the sales has not really dropped. Now, this means labor productivity is improving. The second measure that corporate firms are doing, as I heard, is that they are embarking on labor-saving and efficiency-improving investment that make uses of the such as information technology. So again, this would result in a rise in labor productivity. And thirdly, firms are trying to make a better use of existing human resources. A typical example is that they are relocating employees to departments that have relatively high work demands, busier department, from those less busy departments. Now, in this case, too, labor productivity will also improve. So when these measures are put together and interpreted from the macroeconomic perspective, they are pushing down unit labor cost, and thus put a downward pressure on inflation, at least in the short run. But at the same time, as I have mentioned, these measures are improving labor productivity. So the big question is, so what will happen going forward? Looking ahead, I think prices will rise through the following two channels. One is as the corporate firms' current efforts to absorb the upward wage cost pressure by raising labor productivity near exhaustion. I think there's a limit to what they can do. So I think they will be close to exhaustion anyway, and the very tight labor market then eventually will be translated into higher inflation rates. I think this is a matter of time. And secondly, the improved labor productivity pushes up Japan's growth potential, and therefore better prospects for growth and permanent income would drive both investment and consumption and thus also contribute to higher inflation rates over the medium to longer term. So therefore, it might take a little more time than we had expected to reach the price stability target of 2%, but I don't think we need to be overly frustrated, because the improving labor productivity is something that exactly the third arrow of Abenomics has been aiming at. So acute labor shortage, once again, is driving firms to substantially upgrade productivity. So labor, in this regard, labor shortage is proving to be a kind of ultimate driving force to push much needed structural reforms. And your second question, what lesson can be learned? As I said, we've been going through this deflation for quite a long time. This deflation, I think this ordeal, the Japanese difficulty, I think started with the banking crisis in the 90s, which deprived our banking system of the badly needed power to support the economy. And deflation as a result followed, and this was compounded by demography. A key characteristic of Japan's deflation since the 1990s is that it's been moderate but very, very persistent, and gave rise to the entrenched belief among people that prices will not rise in the future. And this is something that may be called a deflationary mindset. During deflation, for example, the best corporate strategy was to just sit on cash rather than invest. So the prolonged deflation not only stymied the economic dynamism, but also weakened the effectiveness of monetary policy as real interest rates remain high. I think two lessons can be learned from Japan's experience, which I think will offer some insights for other Asian economies, also in answering the questions from the BIS with regard to achieving sustainable economic growth. The first lesson is that ensuring financial system stability and thereby avoiding financial crisis are crucially important. This is because a significant negative demand shock like the financial crisis not only leads to the contraction of economic activity temporarily, but also has the so-called hysteresis effect, and thereby dampens growth potential. In order the impact of negative shock persists through, for example, firms' cautious stance toward investment, including R&Ds. I think in retrospect, actions to avoid financial crisis were not taken swiftly in Japan for several reasons. They include a delay in authorities' recognition of the serious situation and the forbearance policy, or insufficient recognition of impact of non-performing loan problems on the economic activity, and a lack of effective safety net. Having been on the front lines addressing Japan's financial crisis, I cannot overemphasize the importance of early detection or build-up of financial imbalances and establishing safety nets such as a bank resolution framework or a good deposit insurance system. So this is the first lesson. The second lesson is that it is important for central banks to anchor inflation expectations firmly, as changing the deflationary mindset, according to our experience, is not an easy task once it has become entrenched. In this regard, maintaining levels of inflation anchored to the level of central bank's inflation target would lead to securing room for monetary policy responses in case of some negative shocks to the economy. And in addition, in the case where an economy is likely to fall into a deflationary equilibrium, I think it is crucial for central banks to make clear commitment that it is ready to use whatever it takes and use all available tools in order to anchor inflation expectations before it's too late. Thank you.
Thank you. I think it's the right time to ask Dr. Zhou and whether comment on the lessons that we can learn from Japan and Korea. Before I ask him a question, actually, Dr. Zhou, very reputable scholars, I have high expectation because he's in schools and universities, so he can come us and have a very frank discussion. But unfortunately, he is now assigned to be an ambassador of Korea to U.S. So I don't know how much he can be candid. So, but I hope that you can be as candid as possible. So, and also best wishes for your very important task. Korea at this moment, and one of the objectives why we have this conference is that there are several number of Asian countries. We believe there are high probability that this new mediocre secular stagnation or deflationary equilibrium risk. For example, Korea is definitely one example. Thailand, and maybe in the future, so which already having lots of the population aging problems. But as of now, Korea's growth rate is around 2.83% point. Do you really think this is this growth rate, which is actually dropped quite a lot? If you think about 10 years ago, it was like a 5-6% growth, and now it's like a below 3% growth rate. Do you really think this is an indication and imply the risk of the secular stagnation or new mediocre in Korea? And then I think, today, yesterday and today, we have a debate, like whether two Korean officials, Deputy Governor John and the President Kim, I think it's very politely say that the policy advice presented by the presenter is not adequate for Korea. For example, monetary policy. I think if I understand correctly, I think Deputy Governor John said that the risk is not that high. We do not need, if considering financial sector risk, probably having an aggressive monetary policy have more problem than merit. And I think Mr. Kim emphasized the huge fiscal need in the future, so maybe having a more expansionary fiscal policy may be more problematic than not. So kind of different view. So I hope that, so are you really concerned on the Japanization of the Korean economy? And if you so or not, and what do you think is the right monetary and fiscal policy in Korea?
Thank you, Dr. Rhee. I'm sorry I didn't fully participate in the yesterday's discussion and debate, so I'm not quite fully informed about the specifics about yesterday's discussions. Am I concerned? How cannot we be concerned about the slowing down of the economy? But to some extent, I think we should accept this as a reality. Actually, since the mid-1990s, I think around the mid-1990s, Korea's actual growth rate was about 7%. But since then, our growth rate has been declining 1% point every 5 years. And now actually, over the last 5 years, Korean growth rate has been below the world average growth rate. And now we are converging to the industrial countries' growth rate. This means that the weight of Korean economy in the global economy would continue be shrinking, and also the catching up of advanced economy is no longer going to take place, which is not the thing we want. So yes, it is a cause for concern that our growth potential and the actual growth rate has been declining quite fast. But on the other hand, I think we have to accept this because this is the result of a successful convergence and also a sign of a convergence. But at the same time, we think, we find that this is the result of the combination of structural factors which have been discussed in this conference over the last 2 days. Professor Gordon at Northwestern University talked about the performance of American economy over the last 1 century, or could be longer. And he talked about the 4 headwinds against economic growth in the US. I would say Korean economy is also facing these strong four headwinds against the future economic growth potential, perhaps more strongly than the United States. One headwind is, of course, demography, and Dr. Cho of BOK yesterday showed, the speed of aging in Korea, which is unprecedented in the world yet. And also, we are facing quite a rapidly deteriorating income inequality, which will further put pressure on the growth of aggregate in the future. And also, what's that? The quality of, human capital, that Korea still has one of the highest college enrollment rate. In the US, since, according to Bob Gordon, that since 1970s, the college enrollment rate has been dropping. Now in Korea, over the last 5 or 10 years, we also see that college enrollment rate is dropping. So in terms of the demography, quality of human capital, and also income inequality, plus the high debt, as we discussed in this conference, Korea's national debt, government debt, is not so high yet. But if we see the private debt, actually the household and corporate sector is at least as highly leveraged as any other industrial countries. Actually, our total debt, according to OECD statistics, is about 270% of GDP. But our national debt is rather small. It's about 40%. So actually, in terms of the private leverage, Korea is among the highest, even much higher than Japan and the United States. And I have seen only Hong Kong has a higher private debt than Korea, but perhaps Hong Kong, as a city of international business, a center of international business, it could be an outlier. That means actually we don't have much room we don't have much policy tools to further stimulate the economic growth in the future. So considering all these factors, I would say that low growth is kind of the, I don't know whether this is the right word or not, a new normal with which we have to get comfortable with. But nevertheless, I would say that it's a cause for concern because at this juncture of Korean economic development, we need to expand social, welfare expenditure and to strengthen the social safety net because, in order to prevent the disintegration of a social cohesion. And comparing Japan and Korea, for instance, when Japan entered long stagnation in early 1990s, Japan was second largest economy, and its per capita income was nearing to that of the United States. And I understand that Japan was in rank 5 in per capita income. And also it was the largest creditor in the world. But at this point, Korea, our per capita income is ranked, I guess, still about 30th in the world. And we have a little net credit, overseas asset. So we need our per capita income is still below $30,000. So we need still to advance faster and more. But as I said, our structure factors and the point we are standing now at this moment is not very encouraging that Korea could reach further the ladder where Korea could be standing as one of the prosperous industrial countries. So by all means, I think we have to do utmost effort to enhance our growth potential.
Quite, it's not encouraging, definitely. So let me move on to fiscal policy. Minister Basri, I think we talk about fiscal policy. Let me follow up the questions after my introduction. Fiscal policy. If you think about the low interest environment, and when you think about this possibility of a new mediocre, one of the recommendations is take advantage of this low interest environment to expand your fiscal expenditures. And but on the other hand, like we mentioned, that there is serious concern on the sustainabilities. So you have been Indonesia for probably same problems. So what should be the solution?
Thank you, Mr. Rhee. Perhaps let me put the background is like this. As we know that we come to this conference with one of the objectives that we need to promote growth, because many Asian countries are facing a problem that we are trying hard to get rich before we are getting old. That's one of the important messages that we learned yesterday. And then the thing is, our policy instruments are rather limited now. If you're talking about this monetary policy, I'm not a central banker, but correct me if I'm wrong, but seems to me with the direction of the normalization of the monetary policy in the US, and also if you look at the new forecast from the ECB regarding the new growth, about 2.2%. So probably the situation, there is a possibility that not much room for the monetary policy in the Asian countries as well because of this. So the role of the other instrument will become very important. The other instrument that's possible is structural reform. But the problem with the structural reform is easier to be said than done, because the benefit of the structural reform will only appear in the medium term, whereas the cost is immediate. So politically, sometimes rather difficult. So there is a room for the fiscal policy. And I really like paper and a presentation made by Anna Carbocho this morning. I think this is very important when she emphasized about some rooms for the fiscal policy. And I'm talking based on my experience, maybe this is also experience in other country. The issue is more about the quality of spending. Because in my experience in Indonesia, there is always justification to the line ministries to come to the Minister of Finance to justify to us the budget. And many of them are basically not efficient. So let me give an example when we had to subsidize the fuel, the gasoline. The one who get a benefit of this gasoline is definitely middle and upper class. It's not the poor people. So we cut this subsidy, we adjusted the fuel price. It cost me, not to read the local newspaper for 3 months because they criticize me every day. But that kind of policy is important. So the idea is how to transform, to relocate this money into the more productive one. In Anna's presentation, she mentioned about to allocate on the sector which create high multiplier. And she mentioned about the importance of pushing the infrastructure. Yeah, of course, then the question is, if you're talking about infrastructure, what kind of infrastructure? Because it varies among countries. For a country like Indonesia, you could go for the basic infrastructure like road, but I don't know what kind of infrastructures are needed for the case of Japan, of United States, for example, where there's how much room available for this infrastructure, unless you go into IT, the telecommunication. The second one, she mentioned also about education, and I think this is very important, but unfortunately in our experience, we double spending for education for nothing, because there is no conditionality for improving the quality. So the main issue is again the quality of spending. If you're talking about R&D, I think yesterday presentation, our colleague from Northwestern also mentioned about not much impact on Japan and also on Korea, even though they increased the spending on the productivity. So the issue of this quality of spending is a very important one. The second one is we are facing many countries in Asia. Maybe the exception is only India, Indonesia, Philippines, and Bangladesh. We still have this young population. We are facing a problem of the aging population. So somehow the role of the fiscal policy is very important. Maybe we are thinking about providing the incentive for the child care, or you to provide an access for the elderly to participate in the labor market, or you probably, you are being flexible on the retirement age, which will have an impact on the fiscal. So that kind of tax will somehow help us. But the problem is, it's been discussed this morning as well. If you give a room to the fiscal policy, then the politician will take this opportunity to push the deficit into unlimited. So what should be the solution of it? So let me share the Indonesian experience. We are applying the fiscal rules in which the budget deficit is 3%. Of course, can vary among the countries. But the good thing about Indonesia is this 3% is binding. Once the fiscal deficit go beyond 3%, the opposition party will take this to impeach the president. So being a minister of finance, the beauty of being a minister of finance is you could talk to the politician, I would love to support your idea, I really like to interning your idea, but our law, restrain us in the fiscal 3%. So at the given constant of fiscal rules, we need to do some improvement of the quality of spending. And I think this is very important. So the key is there is room for the fiscal policy, but the most important thing is whether this fiscal policy will end up with the good quality of spending or not. The second one, we cannot go beyond a certain amount, because in many emerging countries, they are facing of this, the limited pool of fund. So if you go too far for the fiscal policy, and there is a possibility of the crowding out, because some money from the banking sector will be drawn out to finance the local bond. So that's maybe my answer.
Maybe a little harder question. Does it imply that Japan should not, Japan should increase consumption tax as planned next year?
This is really a tough one. I try to be as diplomatic as possible to answer this question. I think, again, I'm not an expert about Japanese economists, but if you look at the structure, correct me if I'm wrong, Nakaso-san. If you look at the consumption tax in Japan is 5%. Is that right? It's 5% now. 8 to 10. Japan is probably the country with the lowest in terms of this consumption tax in the world. The second one is the impact of this consumption tax that will be a broad base. So if we increase just a little bit, it will have a significant impact on the collection of the tax revenue, whereas at the same time, Japan got a problem of this debt to GDP is more than 200%, if I'm not mistaken. So technocratically speaking, this is something that should be done, Changyong. But again, if you're talking about policy, this should be put in the political economy context. Yeah, the question is how to incentivize politicians to see the benefit of this rising consumption. Because if not, leaders are not interested to implement something, especially if later on the one who gets benefit from this policy will be his successor. So sort of like creating the quick wins is also very important while implementing this, the tax. That's my 2 cents.
Thanks very much. I'm sure that ED Kaijuka are very happy to hear that. Okay, Dr. Majun, one question about your paper yesterday. You say that the growth rate in China in almost 18 years later still will be 5%, which means that by 2022, if I just extrapolate, the growth rate of China will be above 6%. This is good news for me. So it looks like there is a really slowdown in China's growth rate. So you may elaborate a little bit whether this is really a little bit optimistic or not. Okay, but at the same time, when I look at your simulation, you focus more on the supply side policy measures. But when you talk about secular stagnation and the new mediocre, what we are worried about, Larry Summers, for example, is a lack of adequate demand side. So I thought that probably in Asia, initially when you talk about secular stagnation, we are thinking about what kind of demand policy we have to have it. But your focus on is more on supply side. So do you really think Asia, even though we are expecting for low growth rate, the policy recommendation should be quite different from demand side to supply side?
Thank you, Changyong. I think the first question, really, I didn't forecast any growth rate for specific years. I was basically saying that in the next 18 years, based on the model, it's a piece of academic work, a couple of structural factors may lead to a slowdown of growth potential to 5% by 2035. That's it. You can disagree with that by putting more structural factors and changing parameters and so on. Whether it's optimistic or it's pessimistic, it's everybody's own perception. Yesterday, Alfred seems to be saying it's sort of reasonable.
I'm happy with that.
I'd like to shift to your second question, which I think is more important. I heard two sets of discussions yesterday and today. One is really by the historians. And they focused on, I think, roughly two things. One is the demographics, and the other is technology. And looks to me, from their perspective, these are the two major drivers for growth potential on a long-term basis. There's no mention of monetary policy by historians. And in my piece, I mentioned three things. For the 18-year period, what I believe as a major driver for deceleration of growth, these are demographics, the environmental costs, and shift of consumer preferences. Again, I had no mention of monetary policy. Now that basically tells my story. I think monetary policy is mainly a demand-side instrument, which is used largely for smoothing out short-term volatility of the economy. And to what extent it can help lift the long-term growth potential, I don't know. I have not seen much of evidence theoretically and empirically. And fiscal policies could be both demand-side and also structural in nature. That's why I thought the presentation, I think, by Anna this morning was quite interesting. He showed that by shifting the spending and the tax composition, you potentially can lift the growth potential by 0.2, 0.3 percentage points. Even though the number is too small from our perspective relative to the sort of type of growth level that we want. But it does show that monetary policy is probably more on the demand side, which has little to do with long-term growth potential. The fiscal policy can possibly impact both demand and supply at the same time. And what I like to emphasize is actually more than fiscal policy, the whole bunch of policies, which I call structural policies, that cost government nothing, but can potentially lift the growth potential by a bigger deal. Now, what are these things? We know that fiscal policy, as mentioned by Anna, you can boost growth by spending more on infrastructure, on better education, on healthcare, on R&D, and so on and so forth. But fiscal policy faces a constraint of debt sustainability, deficit, and so on and so forth. There's a limit on how much you can do in these spaces. So if we switch to financial policies, which is not costing the central bank or government money, but really building the infrastructure for facilitating financing in these activities, we might find actually even better solutions. For example, in the infrastructure space, what we found is that the majority of infrastructure needs to be built with private sector financing rather than government financing. So how do we channel short-term financing in the private sector to finance long-term projects? Most of the infrastructure projects, like railway, subway, water treatment projects, energy projects, the repayment cycle is like 10, 15, 20 years. But typically in emerging market economy, the banking system only provides relatively short-term lending. For example, in the case of China, the average duration of loans is only 2 years. So the solution is really to develop a bond market, connecting the long-term financing with the projects directly. And the other thing that we're pushing actually quite aggressively now is securitization of these loans so that they can be taken off the balance sheet of the banks and be sold to long-term investors, for example, insurance company. I think by working in these areas, it doesn't cost government money, but could be more effective than just a little bit increase in the fiscal spending. Now, the other area that was mentioned this morning on fiscal is spending more on education and on healthcare. But I thought another important way of boosting education, especially for those smart kids but from very poor families, is to provide student loans, which is available in the US for decades, but not available in many other emerging market economies. On the healthcare side, I think critical illness is very important as an insurance subject, as many of the poor families, they actually fall into poverty because one or two people in the family fall into a big illness. And most of the basic insurance doesn't cover these large sum of spending, and therefore a separate, maybe commercial-based critical illness insurance policy will be needed. And just as a last example from the financial policy side is developing this VCPE market to finance technology development. There is some serious study from the US and also increasingly in China that this industry has a strong linkage in boosting the productivity growth through innovation. And these studies show the impact on the number of patents that can be generated, depending on how much venture capital financing is provided. So these are just a few examples of what I call supply-side measures from a financial perspective. Now, just a couple of other things which doesn't cost government money are supply side as well. For example, on the labor side, what China did the last few years was changing one-child policy to two-child policy. And that creates a few million babies, additional babies per year, and 18 years later, they get into the labor force. That becomes an increase in L, which boosts growth potential, for sure, by this simple coupler class production function. And also on the labor side, many countries are now looking into expanding the labor force by bringing women, bringing expatriates, and so on and so forth. And also yesterday I mentioned very briefly on the deregulation side, if you can open certain markets with very high demand growth, for example, healthcare, to private sector, to foreign investors, I think that can generate a lot of growth as well. Let me stop here.
Just a quick question. You think given this high leverages and rapid increase of the credit, do you think pursuing this financial market development is a safe strategy?
Now, I think some of the strategies may be only shifting the composition of financing. For example, if you have a very high percentage of financing that's short-term, but they're actually financing long-term projects, it's very risky because these projects need to refinance 3-4 times in order to complete. So for the same amount of financing, outstanding amount, if you shift the maturity structure to a little bit longer-term one, that actually reduces the level of risk in the system.
Subir, I reserved you at the last, as a panelist because my daughter, when she saw your picture with me and you, and she said that you look really like a wise man. So, especially as an ED at the fund, you have seen lots of discussion of this secular stagnation, new mediocre from a developing countries' perspective, advancing countries' perspective, monetary, fiscal policy, all things. So, I'd rather not to ask you the one specific questions. I'm just ask a broad question. What is your key takeaway from today's discussion and today's panel, and give us some wise answers?
Thank you, Changyong. First, let me thank you and the other organizers, the Ministry of Strategy and Finance, the BOK, and the PIIE for organizing this. It's been a very, very, I think, stimulating immersion, into challenges and prospects for Asia. And before I start, first, I think, can I introduce my daughter to yours? So she may. And the other, Mr. Basri, if you were to live in Washington, D.C., I think you would also hear the argument that the U.S. needs basic infrastructure like roads. So, I don't think that's... I think the way I've looked at it, drawing on two themes that emerged during the inaugural session, One was the statement by the Deputy Minister who said that the paradigm needs to change. So if, we've talked a lot about heterogeneity in Asia, but I think we also need to recognize one core sort of source of homogeneity. What is the Asian model? Why do we refer to it as an Asian model? I think it's basically that all of the countries that we've been talking about today and some that we didn't talk about at all have basically grown on the fact that there has been demand for their products, and in the Indian case, services and products, I suppose, in the West, in the US, in Europe, and of course in this region, of course, Japan would also count in that category as the advanced economy source of demand which allowed these countries to grow. And we've seen this model deliver very successfully for 5 decades, or maybe 6 decades, from the 50s and the whole flying geese formation and so on. Very nicely brought out in the technology discussion, where you saw how generations of countries basically followed the same technology strategy and were able to leverage off that to get the benefits. So I think the fact that the model has, or the paradigm has now become obsolete, which is, I think, a point that the minister made, basically suggests that this access and this opportunity that the Western markets provided, the advanced economy markets provided, no longer there. And so that's the secular stagnation argument, and we're worried about how that's going to impact us. Let me point to the other input we got from the inaugural session. Adam's display of share of different countries, and taken from Arvind Subramaniam's book Eclipse, I believe. In the 1870s, we had Britain and Germany, 2 virtually neighboring countries in that continent. I think we're repeating that pattern now over the next decade, when China with 18% of global GDP and India with 6% of global GDP, effectively 24% of global GDP, are neighbors in the same neighborhood. To me, that's like saying, why is Silicon Valley such a hothouse? Why is it so successful? Because you've got Apple and Google, 2 giants in the same neighborhood, and that provides enormous opportunities and tailwinds to the other actors in that space, and I think that is an analogy that applies to Asia as well. So the opportunity really that we've seen is that we have 2 gigantic economies who are likely to grow at a significant pace over the next 20, 30 years that are going to be pulling this along. And it's really for the region as a whole, for other countries in the region, to try and find ways to exploit that. But that comes with several challenges, and we've had a number of sessions that have discussed those challenges. There is the aging and the implications of that, both in terms of labor force and in terms of the welfare consequences, health and education. I think technology overall, and with all due respect to Professor Mokir's sort of characterization of techno-pessimism, I'm not sure I'm a techno-pessimist, but I think we have to be realistic about the threats that automation poses to very low skill or unskilled and lowly educated workers, which is still, I think, the predominant model in this region, at least in where the numbers are concentrated. The greatest challenge from the Indian perspective, and I'd speak also from the Bangladeshi and perhaps Sri Lankan perspective, is how do you put these people to work? That is the basic growth model that we've been watching other countries do for the last 50 years. And it's going to be very difficult for anybody to say, well, sorry, but that opportunity is no longer open. How do we transit, or how do we take this population for the time that we have left and put them to work at reasonable wages with reasonable quality of service and so on? So there is a great threat from technology. And I think that's something we have to be focused on. How do we deal with this? But I think the basic message that I'm getting out of this meeting, and it didn't come out very explicitly, but this is an inference that I've drawn, is the Asian model has to pivot. The Asian model has to start looking away from the Western markets, the advanced economy markets, where it was logical what does trade theory tell you? It tells you that the more disparate the factor endowments between two trading partners, the more likely there are to be gains from trade. So that was the basis of the 50 years or 60 years of rapid growth. Now we're looking at a situation where Asia is offering the opportunity, but the endowments across these countries, for the most part, if you weight them by people, for populations, for example, are essentially quite similar. So how do you pivot from a traditional or a classical trade theory framework to one in which countries that are essentially similar in endowments are going to trade with each other? Because that's the only way that the model is going to pivot. That's the only way that the opportunity of having these gigantic and long-lasting sort of demand sources are going to be exploited. And there, I think, is what the whole question is about. How do you sustain growth? How does Asia get better integrated with each other? In this context, I think we have to be looking at a number of things. Europe does offer some sort of historical precedence. The European Customs Union, to me, was a very successful example. I'm not commenting the currency union, but the customs union was a very successful example of similar economies leveraging each other's opportunities. The sort of high growth phase of Europe in the 60s and 70s, I think, reflected that. That's a model. Whether it is feasible or not, I think, depends on the collective will to achieve it. This also brings some focus onto the kinds of investments that are going to be needed. It's not, I think generic investment, make more infrastructure investments, more education, and so on. I think we have to go beyond generic recommendations to more specific objectives. How do you facilitate trade between these countries? How do you facilitate the development of supply chains? What sort of skills do you need to support this whole arrangement? I think those are important and more focused questions that we have to answer. And in terms of the trading arrangements, TTP was the talk of the town for a long time, and we now see that has been marginalized. From the perspective of countries that were not part of that arrangement, I think the dominant reaction is relief, because that would have been an exclusive and a region-breaking kind of an arrangement. RCEP, which is a much more regional arrangement, I think basically satisfies this requirement that it is, when it emerges, will actually facilitate the integration of the countries in the region, and so perhaps give some realism to the momentum that I was talking about. How do you exploit the India-China factor in terms of demand opportunities? So that's my basic takeaway. My basic takeaway is the old Asian model is really a victim to secular stagnation. The new Asian model then has to deal with some very critical challenges that really, I think, challenge or question the basis of classical trade theory and move us into a somewhat different domain. I think the reassuring factor is that it's not unprecedented. It's been done in the past. But given the heterogeneity, particularly that the MD referred to in her remarks, but we're seeing it in all of the discussions as well, that addressing that heterogeneity is going to be a critical issue. Thank you.
Indeed, actually, we focus more on the risk of secular stagnation and new mediocre, but we haven't touched very much about what should be an alternative and new growth model. And as you mentioned, I think technology and employment and the policy coordination within the region hasn't been discussed, relatively weekly discussed in the last 2 days. So after the first round, I hope that we can give you the chance to ask more questions from the floor. But Dr. Majon has to leave for the airport at 2:45. So if you have any specification on China, please, ask it in advance. But in the first, please, the floor is open. Dr. Kang.
Ask the prominent panelists on the following issues. Dr. Adam Posen seems to criticize inflation targeting policies for its failure to achieve 2% inflation target. When the central banks adopt different monetary policy strategies, say like the inflation targeting policies or monetary targeting policies, I think very few central banks in advanced economies could achieve the point target, either it's a monetary policy target M1, M2, M3, or inflation target like the 2%. So we may expecting too much if inflation targeting central banks to deliver point target like 2% inflation target in the given period of time, less than, between 2 or 3 years. If current format of inflation targeting policies has been not successful in delivering 2% inflation target, then should we search for the different kind of monetary policy strategy or different version of inflation target policies? So if I may, I'd like to solicit your views on these issues. Thank you.
Let me get a few more questions and then I'll distribute it. Ken, and then I'll go back.
Dr. Gokarn and the managing director yesterday highlighted the source of diversity in Asia as a strength. And I wonder what more can be done in the area of regional cooperation, and in particular, an issue that wasn't discussed, looking at the role of more liberal immigration policy to help offset some of the demographic pressures in some countries.
Okay. Can I get one or two more? At the back.
Okay, Bokunji from the Bank of Korea. My question goes to Hiroshi Nakaso. I know that the Japanese economy attained outperformance in the GDP growth. For example, in the second quarter, it recorded around 4%, I remember, in an annual rate. This is a kind of a structural change or a temporary one, I'd like to ask. And in this regard, what is the possible spillover effects to Asian countries of Japanese economy's recovery? That's my question.
Okay. Let's say about the first set, 3 questions, but given that we haven't discussed very much on ASEAN economies, if you allow me, I may ask one question to Mr. Basri for the issue of the middle income trap in ASEAN countries, which has been last quite long, in last 2 decades, right? So the current discussion of our secular stagnation and new mediocre, do you see some difference? What kind of implication of the new mediocre on this middle income trap issues among the ASEANs? Right? I may ask it later, but why don't I start from Adam? So probably it's my fault that I'm too exaggerate that you're against the inflation targeting, but please go ahead.
No, I would rather defer to the officials. I'd just say that there's a technical point and there's a broader point. The technical point, which we wrote about and many other people wrote about when inflation targeting was being developed, was you could spend a lot of time worrying about whether you had a point target or a range target. And one of the first papers that came out on that was Andy Haldane, way back in the day, did a bunch of simulations and suggested that if you did a range that was real, this is sort of in line with your views, I believe. You did a range that was at all realistic on the error bands of what a central bank should be able to deliver. You would have a range from like 0.5 to 6.5. Now that was drawing on data before the Great Moderation, and so then after the Great Moderation, everyone got used to the idea that you could be very point target oriented or have a very narrow range and be credible. And as I've tried to indicate, I think it's reasonable without blaming any central bankers at all, to come to the conclusion that that was deceptive. We didn't have that kind of control. And when I go back to some of the statements made, for example, at the Bank of England in the early 2000s or even late 90s, but in their inflation reports, there was this false sense of precision. And at the time, why people like me and my more senior co-authors wrote about point targets was, for example, the Swiss had a point target because then your anchor is clear And the whole point is you're explaining why you're going to miss the target 99 times out of 100. And so you're just explaining it, and you don't have this false sense that you're falling in this little trap. The final thing I would say, and this is getting very technical in inflation targeting, which is important, but I feel like what Subir Gokarn raised on trade and some of the investment issues and what Changyong raised are much more important, and what I tried to say in the opening talk yesterday. But the final thing about inflation targeting, which goes with the discussion we had, is that when we wrote our book, we talked about the idea that you should be able to reset the inflation target as economic circumstances changed. And we said that very explicitly. And we assumed it would be a political decision or joint between the central bank and the politicians, but that you would reevaluate. And I kick myself, I'm not going to say anything about my co-authors, but I've been kicking myself for a few years that we didn't realize it was like an exchange rate peg. That if I say I'm going to have an inflation target of 2% or 2.5%, oh my God, I don't want to ruin the credibility by admitting I might want to raise it or that I can't meet it. And so there has been this cycle among central banks to really stick their inflation targets and be very reluctant to change them. And I understand that. It's a very understandable logic, but I think it is suboptimal.
There were a couple of questions. Let me answer in order. Why 2%? Why inflation target? I think inflation target framework is still valid in the sense that a 2% target is not that high, considering the underlying strength of the Japanese economy. Some say 2% is too high. Why not satisfy with 1%? But 2%, I think, is a relevant number. Why 2%? Like any other country, there are probably three reasons why we have to stick to 2 as a level of inflation targeting. One is the statistic bias, upward bias. Second is the need to retain room for policy responses. And third is the so-called global standard to be aligned with the other advanced economies at 2%. And this is against the backdrop of some FX, foreign exchange rate considerations. It's true that we are lagging behind the target dates, the original target dates, but this is due to the fact that, this is partly answer your earlier question, Adam. In our case, at least, we are in a more relatively difficult situation in that our inflation target inflation expectation seems to be had been anchored around 0 after the banking crisis in the 90s. Then this was de-anchored and in transition to 2%. So it's in a relatively unstable situation. I think for all that for that reason, we have to stick to 2% at this point. So I don't think there is a need for us to alter the basic framework of inflation targeting. Immigration, I mentioned about acute, very extreme labor shortage. And just give you the interesting number that foreign workers in Japan has already exceeded 1 million. And last year alone, this number increased by 170,000. So it's relatively a big number for Japan. This is another reflection of the labor shortage we are facing. With regard to spillover effects, first of all, is Japan undergoing structural reform, structural change? To some extent, yes, for the reasons I have mentioned. However, I think this is not enough. I think, personally, among the various structural reforms, I think we need more reform in the labor market, particularly what I call the mobility in the labor market are of particular importance. A spillover, probably we are going to see more policy divergence between the US and the rest of the world, and that means our banks will be pursuing the so-called portfolio rebalancing, which means more investment in foreign currency denominated loans and assets. But this is not confined to the Japanese financial institutions. This is more or less a global phenomenon when you see a policy divergence. What this means is that you have to finance, the non-US financial institution must finance on the liability side, and the dollar liquidity funding requirement gets that much more stronger. And I think this is a challenge that all of the non-US financial institutions will face in the diverging policies in the days, in the month, in the years ahead. In other words, I think the authorities must make sure that the non-US financial institutions have a secure, stable funding sources in dollars.
Subir.
Thank you. Ken, I think the two perspectives I have on this question. One is realistically, immigration reform is probably going to be the last in any stage of sort of regional integration or any process of regional integration. And I don't think it's critical at this point. I think the benefits from free movement of goods and free movement of capital will be very significant. We have advances in technology that allow for very, very geographically distributed supply chains to emerge. So instead of moving people from one country to the other, you move the goods where the people are if the process needs to. And you're reaching a point where people sitting in Bangalore could control factories in Guangdong or wherever. It's already happening. It's a matter of time before you have the need to move people to carry out basic manufacturing operations, I think is just becoming less and less. So to me, this is not a critical attribute of what could be a sort of effective process of regional integration. And I think policymakers have to focus on what is realistically achievable and not get sidetracked by issues that can bring the whole process to a stop.
Minister.
Thank you, Mr. Rhee. I think I agree very much about this middle income trap. It's really a big issue for many Asian countries, especially in Southeast Asia. And I think the gist of the problem would be related to the issue of the productivity. Then the question is how to improve the productivity. Of course, the obvious answer is to improve the human capital. So that's why the role of the fiscal policy become very crucial here, spending on education, and also probably incentive about the technology, and health, education, human capital, basically. But the other thing that's also very important is how can we get this spillover from the some economic activities. And in my view, if you look at the experience in the past, most of the success story of the East Asian countries are basically they put the strategy on two things, industrialization and trade. But there is a risk now, as Caroline Freund gave a presentation this morning about the slowdown of the global trade. Yeah, because it seems to me that trade is a very important for the technology spillover through the export and also the foreign direct investment. And if I may, talk a little bit on this, maybe we should do something to enhance this trade cooperation, because nowadays there is a risk that rising protectionism and also the declining of the trade policy. So let me talk from the perspective of ASEAN. If you compare many regions in the world, ASEAN is still the region with the highest growth nowadays. So we probably could maximize the benefit of it. And then, so each Asian countries could use the intra-ASEAN trade, in order to continue to promote productivity. Other thing is how to attract foreign investment to provide the technology spillover, especially related to training. I understand that some ASEAN countries, the government, they have this government training center. But unfortunately, this, on my experience, most of the graduates from the government training center need to be retrained again. because ill-equipped, because the machinery is not there. So maybe there is room for the fiscal incentive as well to ask the private sector to do a training and make it tax deductible. Yeah. So by doing all of this with the room of the fiscal policy, then hopefully we can manage the issue of this middle income trap.
We have 10 minutes, so now I think I would like, if there is no really urgent questions, I would like to wrap up the today's conference. So I will, instead of for me to summarize the whole today's discussion, I may leverage our distinguished panelists. So I'm going to ask them what is really one important key takeaway they are thinking from the this today's discussion, but less than 1 minute for each. Okay, I will just link if it's got more than 1 minute. So Adam, please go ahead first.
We have so much in common, but we continue to have difficulties linking the short-term macro with the long-term structural. I was very impressed by Carolyn Freund's attempt to do that. I've been very impressed by various policymakers on this panel attempt to do that. And I think that's where the action is, both intellectually and in policy terms. And then the one other thing I would say that I tried to say at the start of the conference, and I'm grateful to all my colleagues for picking up on it, from Joel Mokier to Subir Gokarn and everyone in between. Protectionism isn't just about the trade damage. Integration isn't just about getting a few gains of a few triangles. It's about the way forward for our peoples.
In 1 minute, just two things maybe. One is the free trade. I mean, trade still, I think, is the common interest that the economies in this region share. So free trade, importance of free trade, I think, should be reiterated, and the economies in this region should be united against protectionism. The other thing is that, as I mentioned, there's going to be more policy divergence. And therefore, at some point, the capital flow would reverse. And this is a central banker's perspective, a little bit technical. But in my view, the monetary operation framework in the emerging market economies in Asia has been sort of developed on the basis of prolonged period of U.S. monetary accommodation and therefore capital inflows to those countries. And therefore, the operational framework has been concentrated on the absorption side, draining operation side of the monetary policy operations. So the other way around, as the capital flows are going to reverse, and we might see some capital outflows from these countries. In terms of monetary operation framework, I think you have to concentrate this time around on the liquidity provision side of the operation, and that has to be upgraded as the environment changes.
Joe.
Thank you. I have not participated in all the sessions, so perhaps it may not be appropriate to try to extract some lessons from all the sessions. But by sitting in a couple of sessions this morning and yesterday afternoon, may I say some of my personal observation, which may not be very diplomatic, to be a diplomat in the future. I find that this kind of conference, exchanging views on the fiscal, monetary, and the structural policy is very valuable and will be fruitful in the future, in the sense that we, through this kind of conference, we, both sides, ASEANs and also from the US and the other regions, would be in a better position to understand the country-specific conditions and also the economic conditions of those countries. I think to some extent, we need to review ourselves that we may be too much influenced by the tradition of American modern economics. That in the U.S., for instance, U.S. economic performance has been consistent over the last 1 century or two. U.S. economy has never hit the growth rate over 10%, and I guess over the last 1 or 2 centuries, its growth rate has been between 2, I do not know exactly, about 2% or sometimes 3% higher. So in the US, for instance, the cyclical policy may have been very important. The counter-cyclical policy roles of monetary and fiscal policies may have been very important. But in this part of the world, Japan has experienced in the 60s, Korea is now experiencing since 1990s. China is just beginning to experience a rapid rise and fall of the economic performance, not just through which is not just the cyclical business cycle phenomena, but below the surface, it has many, many structural issues. So I think in addition to this monetary, fiscal, or some cyclical point of view, we need further understand the structural issues of the economy. For instance, what's the ultimate implication of low interest rate policies or monetary accommodation and the fiscal expansion on stimulating the short-term economic performance? But what's its impact on the structural flows of the economy and also its societal impact? I think needs to be further contemplated and deliberated. So in that regard, I guess this kind of a conference is very helpful and fruitful. Thank you.
My key takeaway is that I thought this issue of the secular stagnation and new mediocre is quite important for Asia. But now I feel like, at least for the Asia policymakers, I have to probably reevaluate how they really think is a real issue for the time being, at least in the short term. Probably I have to revisit these things one more time.
The demographic projections, there's perhaps a 30 or 40-year window during which the model has the time to pivot, and I think we have to take as much advantage of that window as possible. So I think there's a lot of reference to using the current situation to build buffers and so on, and that's perfectly valid. But I think it's not just a question of buffers; it's also a question of strategy. I think that's really where the focus should be.
I think we learned from our conference in the last 2 days that we are entering the new normal or the new mediocre. But at the same time, because the problem of the secular stagnation, the aging population, productivity, but at the same time, unfortunately, the policy instruments are also limited. So the question is how to make the best of it, to combine all these policy instruments that are available in order to get this optimum policy, the policy result. And I believe this is something that makes our world become very interesting, because a lot of uncertainty, especially for the policymakers and also people from academic. So one thing, Changyong, perhaps I would say that doing economics nowadays is very dangerous because it's addictive.
Thanks very much. Thanks for the panelists. I think it's time for me to finalize our 2 days conference. First of all, I'd really like to appreciate and grateful for the contribution of the authors, first of all, and also discussant. And we have very excellent papers, and I personally learned a lot. I hope that you do the same. And their contribution will be published in a book. So I'm sorry, but authors and discussant, we may bother you more, a little bit more to have our joint book. I hope that we can have it probably by the end of the year or something. So, but I'm really grateful for your contribution. And also, I'm very grateful for our co-organizers, especially PIIE, Adam, but Jeremy, you spent a really long time in preparing all these things. I'm very grateful. I'm also grateful for the very generous financial support from the Bank of Korea and Minister of Finance strategy, and almost all cost was borne by them, and also all these services was provided them. So I'm very grateful for the two institutions, especially if you do not mind, I think Dr. Sonok is, please, come on. Dr. Sonok is here, and he was the master of ceremony, and in Korea rule, if you do well, and we'll continue to rely on him for doing this in the future. And I have my colleagues, and Ken and Thomas really spent, I apologize that I really pushed them too hard, even, sometimes if I was personally too harsh, I please you can, excuse me at this moment. And also there are several colleagues from the IMF who actually we conscripted them to contribute to the paper, and they really pushed them given their very busy times. So I'm very grateful for many of them, whom I do not want to mention one by one. And also Edie Kaichuka and Edie Choi and Edie Gokarn actually joined us. It was very honorable. So, and also all the participants, and I hope that you enjoyed our conference, and I'm very grateful. And Mori, and your keynote speaker, and he is a really difficult person to catch, but this time I'm very grateful for you to come. And thanks for coming, and I hope that you can enjoy my home country, and then also have a safe trip back. Thanks very much.